Okay, good evening everyone. Welcome to the webinar on financial statement analysis beyond textbooks. This is broadly going to be a short session that is going to cover a few examples on how purely going by bookish definitions of some of the parameters in finance, we might end up making a mistake here or there. Before kind of going ahead with this, we would possibly just outline a couple of things. On your console, you would be able to see some sort of the uh, panel which will give you a chance to ask any questions, so you can type your questions there. Just as we speak, before I can go ahead any further, I wanted to do a quick check whether you can hear me. Is my voice audible? Is my voice audible to all of us? Is it loud and clear? If you can type yes and let me know quickly. And I'm just going to scribble something on the screen. Thank you for the voice bit. I think most of us can hear me. I'll just scribble something on the text and just let us know if you can see this. I've written something on the screen. Can you read what's written on the screen? Great. Thank you. Yep. So good. I think just a couple of quick tech checks that I wanted to do. Done with that. So broadly good to go. Right? Okay. So we'll begin in a minute in terms of the actual content, and we'll first try and outline what are we trying to do and why are we trying to do that, and understand that as we go along, and then kind of move immediately towards a few examples and see how things can get interesting when we are trying to do financial statement analysis, right? I would request you to hold on to the questions till the end. And then we'll have a dedicated time for any kind of questions that you could ask. Just before we begin, so my name is Piyush and I will be your faculty for the day, and I'll basically take you through broadly all the examples and all the data that is there. And as we begin, we're going to look at two specific concepts and look at examples on how they would work in real life as against the textbooks, right? So that's it in terms of the intro. Let's quickly begin with the session today. Now, in terms of our understanding of financial statements and analysis, one of the key reasons on why textbooks sometimes become less equipped to kind of help us deal with real life situations is, one, because of the logistical limitation of the time that typical management programs have in what you could spend learning about financial statement analysis. Two, the way it is kind of created is largely from an accounting perspective, and that doesn't really help too much, in the sense that while it is good to learn definitions from that perspective, real life practical application oriented understanding of a lot of financial statement techniques don't exist in textbooks and are not taught in most curriculums, right? Why is that a problem, and how do we kind of go about working on those is what is going to form the outline of this session now. So typical textbooks teach us two questions. They teach us to answer two questions. The first question is the what of things, and specifically with respect to financial statements it is very important. The what of things, and the second question is the how of things, right? And that's basically going to be two questions, which is going to outline most of our education system, most of our learning that we acquire out of textbooks, right? For example, what is the ratio that talks about indebtedness of the company? If I were to put forth this question to you, what would your answer be to this question? What is the ratio that talks about indebtedness of the company? could you type the answer and give that answer to me? And put all ratios that come to your mind with respect to what is the ratio that talks about indebtedness of the company. And let's write those. Okay, another few seconds. If you can quickly type those. Please name all the ratios that you come across. Financial leverage, right? Quick ratio, current ratio. Okay, so let's put all these down on the text. Fair enough. So when we speak about indebtedness, so I get a lot of answers, but when we speak about indebtedness, it is primarily going to be the debt to equity ratio. That's the most common one that everyone looks at. And typically in itself, debt to equity ratio does not give you a complete picture to a lot of times because you know, it differs from industry to industry on how much debt should a company have in the first place, for example. Right, and there are factors which affect the debt equity ratio in addition to some of the other parameters. So we put in leverage ratios along with it, and I'll explain how leverage ratios become important when you're looking at debt to equity. And then in addition, there is typically a third ratio which is important, which is called as the interest coverage ratio, right? So there's a third ratio which is important, which is the interest coverage ratio. Usually all other ratios like current ratio, etc., show liquidity of a company, and profitability is shown by some other ratios. But if I was to look at purely the indebtedness of a company, that's going to come from ideally my debt equity ratio or my interest coverage ratio, and some sort of leverage ratios could help me gauge whether this is good or bad or ugly for a particular company, right? Next question is, how do you calculate it? So in terms of how do you calculate it, I have a question for all of us that's going to come on our screen. How do you calculate the interest coverage ratio? What is the textbook definition of interest coverage ratio that you know of? You can just select it on the screen that you see there, and we'll see the answers at the end of it. You can just click and select it on the screen that you see. What is the interest coverage ratio? How do you calculate it? So that's the second question we're looking at now. Last few seconds. You can just select it on the screen. Just quickly do that. Even if you don't know it, just make a shot at the question. Okay, so that's broadly it. I'll close this now. And just give me a second. Let's look at the results. So let's look at the results of the poll now. Do we see the results? Broadly, about 58% of us believe that EBIT by interest is the correct answer, and the rest of the crowd is equally divided between EBITDA by debt and net profit by interest. Correct? So that's the set of questions that that's the set of answers that we have chosen at this point of time. Let's gauge what do we mean by this ratio, right? So how do you calculate it? Practically, you're looking at, let's say, coverage. Interest coverage, as the term suggests, is how much your profits are able to cover your interest. Now you're going to pay your interest from the profit before interest. So the correct answer is EBIT by interest. Correct? Net profit by interest could be looked at, but the point is, if you reach a net profit number, that's only after the interest has been paid, right? So technically, net profit by interest may not make too much sense. EBITDA to debt is also a ratio that can be looked at, or typically it's like how much your EBITDA is and how many times your debt is versus your EBITDA. Usually the reciprocal of this is more commonly calculated, right? Having said that, we have been able to answer the what, we have been able to answer the how. Primarily, most of us know about these two numbers, right? Real life, however, starts beyond this. Most of our textbooks teaches this to us. Most of our textbooks talk about this, but real life basically starts throwing challenges that come beyond it. And in real life, the question that we need to answer is not how or what, but why. Right? So why is this important? Why is this number different for different sectors? There are lots of why questions that come. Why is interest coverage important? Why is it important for some industries more than the others? Why is it a problem if it gets over-reported? Why can it get over-reported at times? Right? So the definition is pretty simple, EBIT by interest. We will now look at a few examples and try and understand it. Let's first understand the importance part of it, right? Which is technically debt to equity. While is an important ratio, we don't really know, what is a good level of debt. I mean, there are methods and heuristics that you can use to calculate what is a good level of debt, but practically at the end of the day, what we are worried about is, can you service the interest, right? And that's what EBIT by interest tells us. So that's why this is an important ratio, and more than the actual debt amount, if you can service the interest, whatever your debt is, that's good enough, right? So practically, if you make a lot of profits before interest, then you can take a larger debt. If you don't, then you can't take a larger debt. That's simple as that, right? So that's why interest coverage is probably more important than a simple debt to equity, because debt to equity leaves a lot of things unanswered, right? Why is it important for some industries more than the other? If an industry has a higher degree of operating leverage, right? Now we have read operating leverage. What is operating leverage? It's basically, how much your change in EBIT versus change in sales, right? So companies with huge fixed cost structure will have a huge operating leverage. So for example, you could have a company whose sales is 100 and all costs are, let's say, fixed cost. There's no variable cost. That's 80. So your profit is 20. Now if sales go up to 120, costs remain fixed because they are fixed cost, profits go up to 40. Change in sales 20%, change in profits 100%. The opposite is true as well. Sales fall by 20%, costs remain fixed, profit goes to 0. So effectively, what you're going to do is it is going to kind of increase the volatility. That's what you see. So in any industry where you have a much bigger component of fixed cost, you will find that interest coverage becomes more important, right? Because if things go wrong in a minor proportion at the sales level, that's going to create a huge problem at the bottom line level. So you pick up companies like metals, you pick up any company that has huge capital intensity, any sector that is kind of driven by a large chunk of fixed cost. Hotels, airlines, almost all the cost is fixed. I mean, the next guy who walks into a hotel is not going to increase the cost dramatically, but is a direct flow to the bottom line. In these kind of industries, especially the ones which are cyclical, interest coverage becomes even more important if you're looking at it, right? Now that's the long and short of it in terms of trying to look at broadly the first two questions. Now the third question is, why is it a problem if it gets over-reported? That we know is because you're not getting the correct answer. When can it get over-reported? Why can it get over-reported at times, right? Let's look at examples. And when we look at examples, we'll try and calculate it for a few firms. We'll try and understand the data for a few firms and understand whether or not it makes sense to kind of look at this ratio and how do we anticipate it, right? Let's take an example of Reliance Communication, Tata Steel, Hindalco. Very quickly, I will look at the annual reports. One of the other things we don't do in our textbooks is they don't really talk anything about annual reports in detail. It's left up to the faculty and the student at the end of the day to look at the annual report, which is primarily the most important source of data for us to look at the financials of a company, right? So we'll dig into the annual reports of these three companies. Let's begin. Let's go to the annual report of, let's start with RCOM, Reliance Communication. So we look at the annual report of Reliance Communications, and we need to first look at what is the interest coverage ratio For that, we will need the financial expenses, and those are here, 2869. Just remember this number, 2869. And we need the profit, you know, before exceptional items, tax and adjustment. So that's 504, right? So this is PBT, profit before tax. To get to EBIT, I have to add 2869 to this. 2869 plus about 500 going to get divided by 500 divided by 2869, sorry. So let's do that. For Reliance Communication, we get the number as 2869 plus about 500, so that will be 3370 approximately divided by 2870. That's for Reliance Communication what we see, right? Let's look at Tata Steel. So for Tata Steel, we get finance costs here, somewhere here. These are the finance costs. So that is 4128. And if you look at what is the profit before exceptional items and tax, we don't want exceptional items, so that's 2300. So 4128 and 2300 is what we are looking at. So let's go here and let's write 4128 and 2300 is going to be 6428 divided by 4128. Correct? So that's my EBIT on the top, and that's my interest on the bottom. And let's go to the third one, which is Hindalco, and let's search for the consolidated financial statements and consolidated P&L. And what we should probably do is, just for argument's sake, because there is some interesting data that is available, take it for the last year. That's 4178, and the profit that is available is somewhere around 2280, correct? So about 4180 and 2280. So we look at 4180 and 2280. So that's going to be 4180 plus 2280 divided by 4180, and that's going to be approximately about 6,450 divided by 60 to be precise, divided by 4180, right? Now in all these three cases, you do find that interest coverage is, this is about 1.5, this is about 1.5, this is about 1.2. Usually interest coverage at these numbers is trouble, right? So anything less than 2 is trouble. You need to be cautious, because obviously especially all these are capital intensive industries. If you see a small dip in sales, there's going to be trouble at the bottom line, and then automatically there's trouble in terms of what money you can pay. But my argument is that they might actually be already getting over-reported in the first place. The situation could actually be worse than what it is at this point of time, right? So we do need to actually figure out what is the reason for this over-reporting. I will also just put a simple question to all of us right as we kind of stay here, which is, what do you think should be the rate of interest for any firm that borrows in India? What do you think should be the rate of interest for any firm that borrows in India? And you could probably type the answer and let me know. What do you think should be basically the cost of debt for a company that's operating in India? Give me a broad number and we pick up from there. So you can type an answer. I have answers ranging from 9.5 to 15, 13, 14, 10, 12 before tax. So fair enough, we have a few answers. We have a few answers where all of us basically say anywhere between 9 to 15% should be the rate of interest. Logical. Government of India, GOI, borrows at about 7%. So it's expected that cost of debt for firms should be more than 7%, surely, right? Or 7 to 8%. And especially with these kind of firms which are already indebted, look at the number of debt that all these three firms have. Let's look at the debt. So we have Hindalco. What's the total amount of debt that it carries? And because we are looking at last year data, look at last year data and try and understand the debt numbers. We have 55,000 crore of long-term debt. We have about 11,000 crore of short-term debt, And I'll show you this other current liabilities is also going to be a part of debt. So we have 55 plus 11, that's 66, 67, and another 8,000. We can go and check this other current liabilities. That's note number 13. Let's look at other current liabilities, note number 13. It's always a good idea. So you see current maturities of long-term borrowings, right? Interest accrued but not due on borrowings. So this is all money that is supposed to be paid effectively, right? And liability for capital expenditure, etc. This is all still loan. Even if I ignore it, the number is about 66,000 crore, correct? Now, based on our judgment on what do we think should be the interest cost for these guys, that's 66,000 crore of debt for Hindalco. Let's look at Reliance Communication. Consolidated data, what is the debt number? 29,500 crore. Short-term borrowings of about 4,500, that's 34,000 crore. And if you look at other current liabilities, that's another 14,000 crore. 2.09, should we just quickly check 2.09? That's current maturity of long-term debts, and you see 6,000 crore, 2,000 crore, about 10,000 crore of long-term debt is retiring this year. So they put it this way because it's not short-term debt, but it's a current liability because it's due this year. But it is not a long-term debt either at this point of time because it's less than 1 year. So 10,000 crore plus 29,500, whatever that number was, yes, plus 4,300. So that boils down to somewhere around 43,000 crore at this point of time, right? That's the tune of debt here. So 43 here. Tata Steel, quickly. We have 68,000 crore of long-term borrowings. That's what we see here, and about 16,000 crore, 15,000 crore here. So that's 84,000 crore. Let's write these down just in case we forget. So Reliance Communication was about 43,000 crore. Tata Steel was about 84,000 crore, and Hindalco was about 67,000 crore, right? What should be 10% on this? 10% on this should be 4,000 crore. We see only 2,870 here. What should be 10% on this? That should be 8,000 crore. We see 4,128. What should be 10% on this? That should be 6,000 crore. We see 4,120. And now we realize that technically they are in a far worse shape at this point of time than what these numbers denote. The interest itself seems to be getting underreported. Now why is that happening? Why is the interest actually getting underreported? So what is the issue that we find? We find that cost of interest for these guys is, or cost of debt for these guys, for the first ones is about 6%, second one is about 5%, the third one is also about 6% or so. Anywhere between 5 to 7% is the cost of debt we are getting. That doesn't seem logical because most of us believe that the debt number should be in the line of about 10 to 12% at the bare minimum. If you actually increase the cost of interest to 10%, all our calculations on interest coverage ratio go for a toss straight away, right? And that's unfortunately what is not taught in the textbooks. That you'll have to learn from real life as to why. The next question that should come to your mind is why is cost of interest 5% for these guys? Why is it not 7% at least, which is Government of India? Why is it not 10%? Because these companies tend to be looking at significant debt. So at these kind of debt numbers, your rating should plummet and your debt cost should be anywhere between 12 to 14%, right? But it doesn't seem so. It doesn't seem that they have this kind of a cost. So what could be the possible reasons? Why do these companies have to pay lesser debt? Now, that answer would be available in a couple of areas. So let's look at those areas. Let's start with Tata Steel. What's the debt? Long-term borrowings. Let's go to note number 7, right? Where you see long-term borrowings. Unless you get into note number 7, we'll not get the answer. Let's go to note 7 and try and decode our answer. There could be multiple reasons for this. We're going to look at a few reasons now. Reason number 1. Reason number 1 would be major portion of bank borrowings relate to finance raised by Tata Steel UK holdings and consequently, if you look at the debt, fixed rate, floating rate, majority of floating rate borrowings bear interest rates based on LIBOR, Euribor, or other official rates. Basically, most of the debt is foreign debt, right? Let's look at RCOM. RCOM long-term borrowings 2.03, right? Let's go to 2.03 and try and understand 2.03 in detail. What do we see? Some debentures and then foreign currency loans from bank. Half of the long-term loans reported there are foreign currency loans, which is 13,000 crore, right? Then you have other debentures, etc. And if you look at the loans repayment schedule, again you look at the cost of interest on the longer term loans as on the screen at this point of time, that's between 2 and 5%. So effectively, longer term loans for these guys, short-term loans, again you see some part of that coming from external sources. And then if you look at other current liabilities, you see foreign currency loan from banks, 6,578. Correct? So about 22,000 crore of the loan for RCOM is external loan. A lot of it for Tata Steel is external loan. Correct? So the first issue we find in terms of why is foreign currency loan. Now when you see a foreign currency loan, it is going to understate the interest because cost of interest is lower. But that does not mean the problem is out. Correct? The problem comes in the form of currency fluctuation. Right? There are no free lunches. So effectively, the currency fluctuation should come and start impacting your earnings. Right? It's interesting to look at RCOM's numbers there. If you look at RCOM's numbers, there must be some currency fluctuation on these loans. They do see some currency fluctuations, but they put this foreign currency fluctuation loss under exceptional items, whereas this foreign currency exchange fluctuation loss of 466 should actually be the interest cost, because that's probably how this loss came. Right? So the interest cost gets understated and effectively comes as a separate exceptional loss, whereas in reality this may not be an exceptional loss in the first case. Right? It may not be an exceptional loss because they do have foreign liabilities on their balance sheet. And more importantly, they don't really bring it to the P&L. They just directly cut it down from general reserve, which is even more interesting if you look at it. Right? Now, there's nothing wrong in it. Technically, it's allowed by law. But your P&L should probably see the hit and profit should go down in this context. Correct? That's the first problem, that if you're looking at cost of interest for a firm and it has foreign debt, you need to incorporate the possibility of currency fluctuation before you do any judgment analysis on interest coverage ratio, because otherwise interest coverage ratio will fool us in the entire process. Right? Let's look at Hindalco last year. That's interesting. Now, they say that finance cost is 4178 in the last year. Correct? Now let's go ahead and look at the finance cost there, right? So the first thing so that's in note 33, the first thing that will come under your cash flow, you typically add the finance cost back, right? So 4178 gets added back. If you see on your cash flow, 4178 gets added back, and then you subtract it from cash flow from financing activities. The only interesting part is that while you add back 41 something, on the paying part you pay 5,000, right? So finance cost paid is 5,000 crore, not 4,000 crore as was reported earlier. Let's go further and let's figure out what the company has done looking at note number 33, right? In note number 33, the total interest expenses that you spot are about 5,000 crore. Other costs, loss on foreign currency transactions, income on some borrowing, and then you have something called as transfer to capital work in progress. About 1,000 crore of interest was transferred to capital work in progress. So the second problem that comes is you are treating interest as capex. Now again, nothing wrong in it. It's just that when you are actually evaluating, it will create a problem. When does this happen? This phenomenon is called as capitalization of interest. Let's say you're building a factory worth 1000 crore and you took a loan of 1000 crore to build it, and there's an interest cost of 100 crore on this. What is the total cost of the factory now? 1100 crore. You could put it as fixed asset of 1100 crore and then depreciate it over the useful life, correct? If you depreciate it over 10 years, out of the 100 crore interest, in the first year you will only see 10 crore, which means 90 crore is underreported in your actual interest number, which means if there is interest being treated as capex or interest getting capitalized, you will have a scenario where EBIT by interest will get over-reported because the interest number is over-reported on the accounting definition of interest. So either you use the actual interest figure, because at the end of the day, cash flow wise you have to pay the actual interest. Accounting treatment is all fine, but the bank is not going to say pay me 10 now. The bank is going to come and say pay me 100 now. So if you don't have enough earnings, there's going to be a problem, right? That's the second issue we find. And unless we go and address these issues in real life, it is going to be a problem for us while blindly implementing what the textbooks taught us, right? So the problem was not with what the textbook taught us. The problem was that we need the answer to this question, why? If we can't get the answer to this question, why, there is going to be an issue at some point of time, right? And it's going to come in almost every company that you spot. That's the first observation we have when we look at the indebtedness of a company and we look at something like interest coverage ratio. Unless we get our hands dirty, unless we get application oriented and get into the annual report and understand what is the debt, what is the interest, where is it coming from, we're going to end up making a mistake on this, right? First part. Let's move to the next part. So we know what are the issues that are there. Foreign currency loan, if you spot it, you have to adjust currency fluctuation into interest. So either take interest plus forex losses as the total cost, or you basically have to assume an interest cost in Indian rupees and calculate it based on that, right? Here you can get it from the notes to accounts as to what the actual interest number is, or take interest from the cash flow. So take interest from the cash flow statement. That will be a nearer adjustment to your overall interest cost. Next topic that we look at is, with respect to cash holdings of companies. Let's say a company has some cash holding. Question one is, why should a company hold cash? And then the answer to that why is typically, you may need investments in the near future, and hence you want to hold a liquid asset because you might have some requirements from that that particular cash that is there in terms of either investment or working capital needs of the firm. The second is, where should a company invest this cash, right? So what should a company do with its cash holdings? Let's try and answer this question. What should a company do with its cash holdings? You can choose something on the screen and try and answer this. Even if you don't have a definitive answer, try and just pick up something on what they should do with it. Okay, so last few seconds and then I'll close this. Here we go. And let's look at the answers that we have. About half of us believe that it should be invested in bonds. Just about 40% believe it should be invested in stocks, and some of us believe we should do nothing with the cash. It should be there in the current account of a company, or maybe we shouldn't hold cash at all in that context, right? Let's try and understand this, right? Technically, what is the need of cash that a company has? Now, cash is supposed to be for future needs, and you'll typically want future needs in near future, right? Because otherwise you can always reissue securities to raise this money. And if you're a profitable firm, you'll anyway get more cash in future, right? So when I say in near future, cash is needed, which basically means you should try for it to be as risk-free as possible, correct? You don't want to take too much risk with this money. In any case, some of us answered cash should be invested in stocks. We'll look at that and we'll try and understand that. But cash should be kind of risk-free because cash is a risk-free asset. Why would you want to play around with it till the time your actual requirement of it is there, right? Let's take an example and understand this. That's a small cap company called Salzer Electronics, and I'm going to go to the statements of Salzer Electronics and understand that. So let's search for Salzer Electronics. We have a presentation or earnings presentation from these guys where just take a look at what's the data that we find here, and we look at this slide and we immediately kind of spot that they seem to be doing pretty well because their net worth, which is the shareholders' equity, has gone up from 100 crore to 195 crore. They also say that there is an 83% increase in net worth, right? So obviously debt equity improves dramatically. Only, however, this net worth can go up only by two methods. Method one is if you make profits, but the profit in financial year 2016 is only 17 crore. So the jump of about 80 crore cannot happen without the second method, which is raising securities or issuing stock, right? So when you see here, you see there is some share capital that has gone up, and that's because they've raised money. And so they've issued equity. Now it's a different issue when you issue equity. What is the need of saying increase of 83% in net worth? That's a separate discussion we can have at a later point of time. But the reality is corporate finance tells us that companies should have some amount of cash. Our discussions on FSA textbooks will tell us that companies should have some amount of current assets and something in the form of cash. But in real life, that's because cash is relevant for immediate term requirements. Now what is important for us is to see what did they do with this money, right? So we go to their annual report and we try and find out their balance sheet. So obviously if on the liabilities side something has gone up, so should something on the asset side. There are no two ways around it, right? So let's look at what's happened there. So on the liabilities side, we see this jump that has happened. Now let's look at the asset side. Maybe they were doing some investments because of capex, right? But we see fixed asset goes up from 77 crore to about 100 crore. That's only about 20 crore coming in. We see current investments going up from 80 lakhs to 12 crore. So 12 crore of money has gone here. We see some other non-current assets going from 20 lakh to 19 crore. So about 19 crore has gone here. And we see trade receivables have also gone up. We also see short-term loans and advances have gone up from 22 crore to 38 crore. So that's how it basically might be balancing itself out. All the data has gone, but surely all the 80-90 crore raised has not gone into capex. Some part of it has gone into other non-current assets, note number 15. Some part of it has gone into short-term loans and advances, note number 14, and some part of it has gone into current investments, note number 12, 13B, sorry, right? So let's look at 13B onwards. So let's look at 14. We have 14 here, so let's look at 14 here. There are some loans and advances that they have given out 8 crore going up to 22 crore. That's something that is given out, so that's unexplained at this point of time. As an analyst, you need to dig that further. They have something which is classified as non-current as a column, and then is classified in below 6 months. So we really don't know what this is, which is going up from 20 lakhs to 19 crore. This is unexplained. So this movement of about 19 crore is unexplained. There's this other movement here on the top of about 13 crore which is unexplained. And then you look at the investments that they have done. Now, it's not a huge amount. It's about 12 crore that is there. So it's not huge when you compare it to the overall firm number. but they have invested in infrastructure fund, mutual funds basically, Reliance Equity Fund, Discovery Fund, mid-cap fund, frontline equity, top 200 equity. They have said Canara Robeco mutual fund, but not given which scheme in that. Then they've said another Canara Robeco here. This probably is a liquid fund. Liquid funds are riskless funds, or they invest in very short-term maturity bonds. So typically the money is riskless, but all this money here is not necessarily riskless. Dynamic bond fund is not necessarily riskless. So we go back to our previous question as to what should a company do with the cash, right? Whose cash is this? Cash in a company always belongs to the equity holders, right? Now you are a shareholder in this company. You have just given money to this company, and the first thing you realize is you don't know what they're using it for, because they've not explained it very clearly in the annual report at least, right? They might have explained it elsewhere, but the annual report doesn't say too much about it. Two, they take your money and go and put this money in a mutual fund, which is basically investing into the stock market, right? Now the question you should ask to this company is, why would you need them to invest money in the stock market? You could have done that yourself. And this is a company that is in electronics. It is not even a company in financial services. So if you had to invest in SBI infrastructure fund, you could have done that yourself. Why would you buy the stock of Salzer Electronic, technically giving them the money, and then them investing in a stock market fund? And remember, cash needs to be riskless for multiple reasons. One, it is, so either it is for near-term requirement, and if you need this money in the next 6 months, that's probably why they would have raised this money, and the stock market falls 15% tomorrow morning. Let's say there is some sort of an issue in terms on the political front, and the stock market falls. What happens to the cash? That's a risk the company cannot afford, right? And if this money is for the long term, then you might as well not have raised this money, because you're a profit-making company. You should make money out of your cash in the long run automatically. There could be a third reason, which is you are undecided. So you just decide to raise funds. Now, that's not a very good reason in terms of proper financial analysis. But you, let's say, decide to raise funds and you're undecided, even then it should be in risk-free assets. Why should it be in risky assets? Because if you're undecided, you surely don't want the stock market to decide for you as to what should the company do. So textbooks will tell us a certain amount of cash is there. Textbooks don't tell us what cash. That will only be told to us by the stock market, or that will only be told to us by corporate finance in real life. And a simple analysis of this company might show that debt equity has improved, but that's improved at the expense of raising equity. So equity holders have been diluted, point one. More equity for the same value of the company, so everyone owns lesser of the company. And two, why did the company raise money if they didn't need it? If they had to go and invest in stock markets, why would you raise money to do that, essentially, right? That's the problem in this case. And again, all we were doing, we were trying to answer this question, why did they raise money? Why did net worth go up? And if they raised money, why did they raise money? Did they use it for capex? If not, why did they not use it for capex? Where did it go? And then why did this go into the stock market? Because that's a problem, right? Now, don't get me wrong. We probably don't have the answers to some of these questions. That's okay. That's fine, right? Which basically brings us to a summary of what we have discussed so far in terms of trying to understand further steps for us. That's broadly the two topics I wanted to discuss today, where textbooks probably give us definitional perspectives, but don't tell us how to deal with real life situations when analyzing a company. The steps for us to go there is that application of learning in real life is necessary. Practice on a few firms what you have already learned from the textbooks. If you don't, that is not too useful, because calculating ratios and noting observations is not going to help us in real analysis. I mean, technically firms don't recruit financial analysts to tell debt to equity as a ratio and to tell their definition. Honestly, if you had put in the question on what is the debt, what is the ratio that tells you indebtedness to Google, you would have received the same answer. And if you had asked how do you calculate it, you would have still gotten the same answer. In fact, Google will also throw calculators in case you are keen on getting that. Surely companies are not recruiting us to do purely Google. And in the world we live in, if we are doing these sort of procedural tasks, we're probably not required, because pretty soon the machine will do it. And already machines are doing it, right? We are required for the next part, which is curiosity of our head, which is why is the number moving? So the key suggestion is that on every question you have to ask why. On every ratio, on every number, you have to ask the question, why is this number moving? Why are we calculating it? Why are we studying accounts? Why are we studying cost accounting? Why do we use one ratio over the other? Why is a certain ratio more important for one sector than the other? Why is one company doing better than the other in the same industry, right? It is important for us, and that's the key crux in financial statement analysis. It is important as an analyst for us to ask the right questions. Once the right questions are reached, the right answers will be searched for. The problem is we don't ask the right questions. And to us, essentially, analysis is not about finding the right answers, but it is about asking the correct questions. Textbooks, unfortunately, don't equip us to ask those correct questions. In fact, textbooks are not necessarily at fault. It's the entire education system which does not equip us specifically to ask those questions. If you want to ask those questions, you have to continue practicing it on a lot of the companies, because that's when you will realize something is wrong with some sort of firms. You have to ask the question why every time, and you do have to do analysis. Remember, it's called financial statement analysis. It's not called financial statement calculation or financial statement observation. Saying sales has gone up 20% is an observation. The problem is trying to find out why is sales going up. Saying operating margins have gone down from 10% to 8% is an observation. Everyone can see it. Why did they go down for this company and maybe not for another company is analysis, right? That's the stage you would want to reach. That's what comes beyond textbooks. That's what will come only with application. That's not going to come without application, right? That's broadly it in this particular session. We'll move on to questions in a second. You'll receive an email from us with respect to some of the work that we do. We do have a few courses on similar lines that run around talking about financial statement analysis and valuation, etc. And we will have certain offers for people who have enrolled for this session today. You should receive an email on that by end of day today, maybe in the next hour or so, outlining it. If you need any clarifications around anything, please feel free to kind of get in touch with us around that. Any questions at this point of time? And I would request you to restrict it to what we have done today so that it stays there. But if you have anything in your mind, you can anyway shoot it. I'll let you know. Any questions that we have? I have a question which says, what if a company invests on bonds? It can invest in bonds. There is nothing wrong in investing in bonds, just that bonds carry risks as well. So if it is kind of short-term bonds and are kind of good issuers, that's fine, right? What is the problem with long-term bonds? Long-term bonds bring in interest rate risk. If rates go up, bond prices will fall. That's a problem. Long-term bonds bring in default risk, right? There are companies that have defaulted in the recent past. Amtech Auto defaulted on the debt. A few mutual funds held that debt. You suffered losses if you're an investor in that bond. So if you're investing in a short-term bond, that's fine. So typically you find a certain category of mutual funds called liquid funds. They're called liquid funds because of the liquidity they provide. They generate about 5 to 7% of return, and they invest in typically overnight or very short-term bonds. Very short-term bonds or overnight bonds basically remove both these risks. Interest rate will not change overnight, and even if it changes, if some of us have studied the concept of interest rate risk, the longer the bond's maturity, the bigger the movement because of interest rate changes. So you want a very, very short-term bond so that if rates go up, it doesn't get impacted. So liquid funds allow you to do that. Otherwise, you just hold it in current accounts, or if you don't need it for a certain period of time, do an FD with that. I can understand that if there is a lot of cash, like for certain set of companies like Infosys, you are sitting on about 30,000 crore of cash, and you're not going to use this in the near term. You're probably going to use this over a period. So from 30,000 crore, you probably can invest some in long-term bonds. You can eliminate some of these risks, interest rate risk and default risk. Default risk, obviously you'll have to kind of invest in a default free kind of security. Interest rate risk can be eliminated by holding it to maturity. If you just buy a bond for, it's like a fixed deposit, right? If you are in a fixed deposit, interest rate movements don't affect you because you will take your money out at the end, and hence all the payments are kind of fixed. So typically in that case you could invest in bonds, but otherwise to keep it risk-free you have to put it in the liquid funds, right? How did I say that interest coverage ratio should be more than 2 for a firm not in trouble? I think there is no thumb rule for that. There is no thumb rule for anything in finance. I mean, technically textbooks talk about a lot of rules, but they're all nonsense technically. What is the rule is, broadly you will note that firms, let me actually clear this out, it will be easier for us to look at it. Broadly, when you look at firms, you want the firm to be able to cover your interest at least 2 to 3 times. If it is not covering at least 2 to 3 times, there is a problem. There is a problem purely because there is just too little leeway in terms of any movements. So I mean, I said 2, but in real life if I were to actually get stringent, it should be 3. Anything less than 3 is trouble. Anything between 1 to 1.5 is serious stress. Anything less than 1 is already in default territory. Anything greater than 3 is fine. Anything greater than 10 is irrelevant. They don't have enough debt. You're okay there. Now that's a heuristic you can use. You can look at companies in 2010, calculate these ratios and check how many fell in what area and how many went into trouble. You'll find that these typically hold more or less fine, right? So that probably answers your question, but there's no thumb rule. There is no thumb rule. It's not that two firms, if both of them have an interest coverage ratio of 1.5, they are equally affected. They may not be. It depends on industries. It depends on a whole host of other factors. What are the 5 most important ratios to see while analyzing any company's financial statement? I think interest coverage ratio would be one. You would probably want to look at what's happening to working capital and understand that, although that I think is also taught incorrectly in textbooks. You would probably want to look at current ratio, but again that's a derivative of working capital and that's taught incorrectly. You would want to, it's not taught incorrectly, it's that the perspective an analyst uses is probably not very correct when you're looking at a current ratio. The next bit you would probably want to look at is anything related to your debt, which is debt equity and you know how much of data you have there. You would probably want to look at incorporation of some ratios from cash flows, which are not a lot of textbooks teach us. Because at the end of the day, all your ratios that are there, profitability ratios, etc., that come from the P&L are prone to accounting issues. So, you know, whether depreciation rates are higher or lower, whether you're taking those numbers into consideration, that could be something that you keep in mind. In addition, turnover ratios are useful, which will tell you, you know, how much sales you generate on fixed asset, for example, when you look at fixed asset turnover ratio. So those become important. But again, I mean, the reality is calculating those ratios is not important. practically if you can dig deeper, then all these ratios will become important in one case or the other, but you have to ask the correct questions, right? So hopefully that answers that question as well. I think a few of you had asked that question in terms of what ratios should you typically look at. I mean, if you want to do proper detailed financial analysis of ratios, then you would want to kind of look at a lot of details on a lot of companies. But yeah, broadly, debt of a company, ability to repay that. You may want to look at what kind of operating leverage the sector has. You may want to look at what kind of working capital numbers the company has. You may want to look at some sort of profitability numbers as well, because at the end of the day that is important. And you would want to incorporate some sort of cash flow analysis into the overall picture as well. And then you dig deeper into a lot of the other nuances that come to you, right? Return on equity kind of numbers also become important in certain conditions. Turnover ratios become important in certain conditions. Hope that answers the question, right? Okay, so that broadly brings us to an end of this particular session. Hopefully you enjoyed it. As discussed, we'll send you details of our programs over email. Please feel free to kind of get in touch with us at any point of time. And we hope the session was useful, right? Okay. Is it okay, one last question, is it okay for companies to invest in money market securities? Yes, so the short-term bonds are called money market securities. So your call money or overnight bonds are those which are there, and that's where liquid funds invest. So companies could directly do it, CPCDs, or typically it's easier for them to give it to a mutual fund who does that, right? Okay. So that's it from me. Thanks a lot. If you have any queries, please feel free to kind of drop us an email, and we'll be glad to kind of assist in whatever way we can. Do follow us on our blog. You typically will find a lot of updations on our website. If you go and click on resources, you will reach the blog tab. We'll anyway send you a link to access that in the email that we send you. Right? Thank you. Thanks a lot. Have a good evening. Bye-bye.